welcome to this special series we are launching today, State of the World 2011. In this series, we get you an array of brilliant economists and policymakers, many of whom were those rare men who saw the 2007 crisis coming. We've invited them now to check out how they see 2011. We inaugurate the show with two stalwarts, Joseph Stiglitz, the Nobel Prize-winning economist from Columbia University, and our own Dr. YV Reddy, the one man whose stubbornness helped India get away from the crisis with minor bruises. Professor Stiglitz and Dr. Reddy, welcome to the show.
Nice to be here.
Well, Professor Stiglitz, let me start with you. Do you think this second round of quantitative easing in the US will result in some kind of a recovery in that country? Will the first two quarters of 2011 show some signs of hope?
I think it's going to be basically a negligible effect. And the reason is pretty clear. The short-term interest rates are already down to effectively zero. Government can borrow close to zero, and that has not re-energized the economy. Lowering long-term interest rates by a few tenths of a percent is not likely to have much of an effect. Large enterprises are awash with money. Reportedly, they have something like a couple of $1 trillion available. So what's stopping them is not too high interest rates, but a view that it's too risky to invest in the United States. Meanwhile, the small firms, the SMEs, can't get access to capital. But again, changing interest rates by a little bit is not going to change that problem of lack of access of capital. The only way that it's likely to have any substantial effect is through competitive devaluation. Lower interest rates are often associated with a lower exchange rate, and that helps our exports. It's the 21st century version of beggar-thy-neighbor policies that marked the Great Depression.
Dr. Stiglitz, many recognize that QE2 won't work, but some economists, including Ben Bernanke, are talking of even more QE as a result. Do you expect a QE3 in 2011? And, of course, there have been voices of protest globally against this competitive devaluation. Do you think the US will defy this global opinion and still go in for a QE3?
I think the discussion is likely to be very much affected by how things are going in the United States. But almost surely it will be clear that quantitative easing is not working at home in the United States. Quantitative easing is generating large opposition abroad, and given the benefits are low and the costs are high, I think there will be increasing opposition to a third round. The other argument that will be made is that in response to quantitative easing, countries all over the world are going to be engaged in actions to try to mitigate the onslaught of capital into their countries. Capital controls, exchange rate intervention, taxes, all the things we've already seen. And that obviously is creating a more fragmented global financial market, something that in the past at least, the United States is very strongly opposed. So I think it will be increasingly clear that it may not even be in the interest of the United States to push a third round of quantitative easing, and the benefits that I suggested, the benefits that arise from competitive devaluation, even those benefits may not appear.
Well, Dr. Reddy, how do you see the global currency market in 2011? Will it be a continuation of the dollar declining, devalued by the US, and Asian countries continuing to buy dollars to keep their currencies from appreciating? I mean, in short, is it a continuation of currency wars?
Let me start with first agreeing with Professor Stiglitz about the quantitative easing not being the perfect solution. But I think if from a point of view of practical policy making, if it is clear that fiscal initiatives which are ideal may not come through, what are the options for the public policy? If fiscal policy, which should be undertaken, is not likely to be undertaken, what should the monetary authority do? Keep quiet, or at least do something? Perhaps that is the background in which I would see, rather than essentially in terms of competitive devaluation, because given the preeminence of dollar, if there is greater uncertainty, then in spite of all the doubts about the dollar, it is still it has the safe haven effect. So I am not so sure whether the dollar value will necessarily be eroded in the short term, though the confidence may be eroded, but there are not many other options. So yes, it will be very messy. The global situation will be very messy. From the US point of view, there are two possibilities as they go forward. They are not. I think they still hold on to the old stated position: my currency, your problem. So that would continue to...
So, my currency, your problem. That's a Reddyism. Now, if you think the US will persist with this dollar devaluation, then do you think commodity inflation will be Asia's and India's biggest headache in 2011?
If the private demand picks up, in USA, I think in a way the policy would have succeeded, and one should not rule out some improvement in the private sector demand because of various actions already taken. However, there is a real danger of what you are mentioning, that there could be a significant increase in the commodity prices because the liquidity is flowing, and that can happen both in terms of commodity prices and in terms of asset price bubbles. And public policy in many countries, developing countries, can moderate but cannot eliminate this pressure.
Dr. Reddy, you also referred in your last answer that really there is not much of an alternative to the dollar. But, we've already heard of China trying some bilateral arrangements. Do you think we may see dollar slightly losing its status as a major reserve currency in 2011?
I think it's better to Professor Stiglitz, perhaps, and more appropriately.
All right, Professor Stiglitz, your take, your question.
Okay. Well, first, the value of the exchange rate is determined by many factors, of which the interest rate is only one. And you might say, fortunately for the United States, or unfortunately, depending on what your objectives are, Europe is having its own problems in terms of the Irish crisis, a number of the countries are facing severe financial problems. I sometimes likened exchange rates to a negative beauty contest, of which is the ugliest. And at one time or another, at the beginning of the crisis, the U.S. was winning hands down. We had created the crisis, but then it looks like Europe took us over, and now then for a while, U.S. looked even worse, but now it looks like with the Irish crisis, Europe may wind up as the ugliest. But in any case, the result of that is that the value of the euro is weakened, the strengthened value of dollar. It is still true that quantitative easing lowers the value of the exchange rate relative to what it would have been had interest rates been higher. So it still has a relative effect, but the question is, what is the base on which you're comparing? In terms of the replacement of the dollar currency, Dr. Reddy and I both were on a UN commission that looked at the global financial crisis, and one of our strong recommendations was that over the longer term, or actually over the medium term, there is a real need to create a global reserve currency. This was an idea that Keynes talked about 75 years ago, but I think it's an idea whose time has come. And after we issued our report, the idea's gotten a lot of support from many of the countries that hold large amounts of dollar reserves. But this is not going to happen overnight. We're not, your focus has been on 2011. I wouldn't anticipate this happening in 2011, but I think that what will happen in 2011 is that there will be more discussion of the creation of this kind of global reserve currency, because there will be increasing awareness of the difficulties the world faces with such dependence on the dollar, which itself faces so many problems.
Right, Dr.